You might have seen in some news articles or your daily news digest mentioning about the central banks meeting to decide the interest rates for the upcoming period. Often these meetings gain much traction and are seen as a big economic event. Let's try and understand why it is a big deal and how does it affect common man in general. So banks provide loans. In return they expect some interest on the amount, which is usually called the cost of borrowing. This interest is distributed over a period and decided by the interest rate. What the rate would be is decided by the central banks. If the rates are high, people would not prefer taking loans for their needs unless absolutely necessary. What if one day central banks say that they are seeing the economy growing at a slower pace than expected? In order to facilitate growth, they lower the interest rates. With this decision, suddenly the cost of borrowing has come down. Loans have become cheaper and look lucrative. Companies take advantage of this and begin with their expansion plans. This increases employment, which puts money in people's hand, and as a result, consumption expenditure increases. With increase in consumption, companies see profit increase, which is then used in increasing supply and further expansion. In this way, lowering interest rate has triggered a growth cycle and increased the circulating money within an economy. This change by central bank comes within the category of monetary policy, as it regulates the amount of money circulating in an economy. Now you may ask that with low interest rates we have all good things happening. So why bother increasing them? To answer that, let's shift our focus to demand supply curve and how interest rate changes the equilibrium condition. Shown in the picture here is a demand supply curve. The x-axis represents output supplied or consumed and y-axis represents the corresponding price. Line S1 with positive slope is the supply curve. Positive slope because as price increases, companies get encouraged to increase production and hence output increases. Lines D1 and D2 with negative slope denote the demand curve. Negative slope because of the fact that increase in price level decreases consumption of the output supplied by the companies. When interest rate decreases, demand curve shifts to the right. This is because decrease in interest rate increases the money supply of the economy. This increased supply eventually reaches the company via increase in consumption. Hence we see sudden jump in demand for same price level. Thus the right shift from D1 to D2. With this shift, intersection of demand and supply curve, also known as the equilibrium point, changes from E1 to E2. From the graph, we can clearly see that price levels at E2 are greater than price levels at E1. This is inflation, by far the biggest drawback of low interest rates. If this inflation is not controlled using right measures at the correct time, it leads to hyperinflation, which is a disastrous condition for any economy. So after few quarters of low interest rates, central banks are bound to increase those for prices to remain at optimum level. This completes one cycle of monetary policy triggered growth. Next time when you see inflation causing havoc after a prolonged period of low interest rates, do remember that it is but natural. This is it for this video. In the next video we'll discuss how interest rates affect the stock market. So do like and subscribe, and yeah, stay tuned.